Good morning, students. This morning we are looking at basic accounting, first semester. Last week we looked at the account from the beginning to the source book. We look at the source book. That's where we are looking at. But time will not permit us to go back to some of the things we did. We've seen the definition of accounting. We've seen the working and some other accounting. Then today, before I move on, let's look at the division of accounting. The division of accounting. The accounting has a lot of 4 divisions that we need to see. The first division is financial accounting. The financial accounting. This deal with recording and communicating information to enable the users to assess the performance of the enterprise. At the end of the year, you will go to your account and see if you made a profit or you made a loss. And if you made a loss, there must be some adjustment that you need to make. Then number 2, we have management accounting. The management accounting prepares futuristic accounting information, estimates and projects such as budgets to assist management in decision making. The management accounting are mostly the internal account that tells us what is happening the inside before the financial account is prepared. So you are able to know, to project, to see if your accounting is okay or it's not okay, if you are making profit or you are not making profit, if revenue is lower than the income. So what do we do? Then the management need to be told what to do so that they can take decision. Then we look at auditing. Auditing is that branch of account that examines the financial statement and underlying records of an organization and report thereon to the stakeholder, management, or to an internal auditor. Now, auditing, I told you auditing is of 2 ways: the inside auditing done by the accountant, and the external auditing that have to be verified by the external auditor. Now, for you to prepare your financial statement for the year and send it to CAC or to CAMA, you need to prepare the internal account. After you finish preparing it, then the external auditor comes to verify it if it's okay. Now, if it doesn't verify the account, there's no way that you can prepare. The CAC can accept it, or CAMAD can accept the financial statement of the account. Then 4, taxation. Taxation is that branch of accounting that deals with the levying and collection of compulsory contribution on the citizen of a country in order to defray expenses and incurred by government. Now, what we are saying is that taxation is everybody who is up to the age of 18. Once you are doing a job, you have to go back and pay your tax, and because it helps the government. Now, every company also pays its tax. Every company pays. That's why you see profit after tax. That's after you have been taxed, then you go to profit after tax. Last week, we talked about users of accounting information. We talked about that. We don't need to go back to that again. That the importance of accounting information, we look at the importance. Accounting information can be used for decision making. It provides permanent record for all transactions. It helps to determine the profitability of the company. And let's move on. That we've seen the users of the accounting. We have the government, we have the owner, the stakeholders, the managers, the leaders. That means the employee, the suppliers, the customers, and the employee. Now, you also need to know that the competitors, they also want to use that to hit you down, to know that if you are doing well or you are not doing well at all. Then we also look at the financial analysis, which is advisors. They need to advise the organization if to reduce staff, if to diversify to another product is very relevant. Then we look at the characteristic of a useful accounting. We say it's relevant. It is very relevant. We need to, so that we'll be able to know if the information we are having internally is okay, then it's relevant to the information users. Then comprehensibility. That means it has to, nobody should skip anything. Everything must be done into two. All the things must have a value. That is the cost on everything that you are doing. Then we look at reliability, or the accounts, we must be able to rely on it, that it is correct and is not biased in it, because the law also, we need to know that the law requires that the auditor, who must be a person of independent of the company and holder of approved qualification, has to verify it to make it reliable. Then we look at completeness. It must be complete. It must meet with the objectivity of the organization. And one of the objectivity of the organization is to know if they make profit or they don't make profit. Then timeliness. We look at comparability. I think we've done this last week. Some of them we've done last week. Then we look at then let's continue from there today and move on to accounting principles and convention. Accounting principle and convention, we did that also last week. So don't let us go there again. The going concern and everything, we look at that, realization, the objectivity, we look at that last week. Now, today we are looking at the accounting equation. Accounting equation, the totality of financial accounting is based on the accounting equation, the double entry principle evolved from this equation. This unit analyze the various components of this fundamental. So we look at the accounting information equation. Financial accounting is based on the accounting equation. For a business to commence operation, it must have resources, and these resources must be provided by somebody. The resources possessed by the business are referred to as assets. Assets, when we talk about assets, we are talking about your fixed assets and your fixed assets and the current assets. Why the asset, why the supply refer to the same resources asset as capital. Somebody who supplied the money is known as capital. And in other words, capital is equals to asset. Capital is equals to asset. That means if you add your fixed asset to your current asset, all you have at the end of the day is your capital. Now, if you don't have anything on the other side of your account, then you carry it forward as your capital. Then we now look at the other one, say capital plus liability is equals to asset. When we say capital plus liability is equals to asset. Now, what are your liabilities? Liabilities are those things that possibly you borrow money. I said the last time that it's not every liability that is consuming money. That liability that also bring money to you, like you collect loan from the bank, it's a liability, but it's a loan that brings forth good assets to the organization. So we say capital plus liability is what asset. It can be said that the two sides of the equation will have the same total. This is because we are dealing with the same thing from two different points of view. That is both capital liability and asset resources. If it's a fact that the total of each side will always equal one another, and this will always be true no matter how many transactions are entered into. The actual assets, capital and liability may change, but the equality of asset with that of the total of the capital and liability will also hold true. Then we now look at asset and liability. We look at what is asset. Asset consists of the properties of all kinds, such as building, business building, machinery, furniture and fitting, motor vehicles, stocks of goods, as well as debt owned by customers, cash at bank and cash at hand. The last four items, stock of goods, debit owned by customers, cash at bank and cash at hand, all are called current assets. What we are saying is that there's a current asset and there's a liability and a fixed asset. The fixed asset talks about the building, the machinery, the fixtures and fitting, the motor vehicle, stock of goods at close. And also when we go to the current asset, we look at current asset from the angle of stock of goods. That is the closing stock of goods, the debt, the debtors owned by customer, that's we call debtor, cash at bank and cash at hand are all called current assets. Now, because they can be used within 12 months, within the other are called fixed assets because they can be used for more than a year. What we are saying is this: the fixed asset is a continuous, asset that you use continuously as the government, as the company or the firm, grows up in age. They continue to use the same asset continuously, except there's depreciation on them and they have to be removed. But on current assets, they run within 12 months. They run within 12 months. Then we look at liability. Liability consists of money owed for goods supplied in the firm or expenses of loan made to the firm. Goods supplied by supplier, including unpaid expenses. Liabilities can be divided into long-term and current liability. The long-term liability can take about 2 years, 3 years, 4 years, even 5 years. That is money. Now, things like debenture. If you will talk about debenture, they stay for so many years. So current liabilities are the money owed by banks and that have to be paid within a span of 1 year. So the long-term liability are those repaid beyond 1 year, while the current liability are those repaid within 12 years. Then we look at capital. Capital is often called the owner's equity. The capital is called the owner's equity or net worth. You say, what is the net worth of that organization? People want to know the net worth. And you need to understand that the net worth of the organization is both the asset or the asset, the current and the liability. I mean, the current asset and the fixed asset and the current asset of the organization. And the net worth, that's liability, consists of money owed or collected from outsiders. Money owed or money collected from outsiders, possibly money borrowed from the bank to make up some things in the organization. Then we'll now look at the resources equals to assets. Resources is equals to asset. When we talk about resources, we are talking of the combination of fixed assets and the liabilities, for the capital, then this thing. And don't forget that we said the capital is also called the owner's equity or net worth. Owner's equity or net worth. Then we look at the asset is equals to capital, that is owner's equity, plus the liability, that the creditors. The creditors. Now, thus the accounting equation, if both the owner and the creditor provide resources, will appear as follow: asset is equal to capital plus liability. Now, you can do when you were in secondary school, you did subject change of formula subject, so change of subject formula where you can do. Now, also for you to get your liabilities, it's very simple. It's just asset minus your capital. Then you get your liabilities, or otherwise you can throw them around to make sure. Then we look at assets. Asset is 182,000. It's equals to 100,000 the capital plus 82,000, which is the liabilities, and that gives us 182,000 naira. It can be seen that two sides of the equation will have the same total. This is because we are dealing with the same thing from two different points of view. That means asset, you have your 182,000, and your liability and your liabilities, then you have you have 182,000 also there. So again, we can represent that statement below in another way and look at resources. We say, who supplies the resources? Who supply the resources? The owner. The owner supplies the resources, and other people, the people that borrowed us money, they borrowed us money to run the organization. They all supply it. Now, resources like the stock, if you don't have enough money, you can always call your customer to provide for you that on credit, and you pay them later. Then that means you are owing them, you are a debtor to them. Then what are the resources assets? It is true that the total of each side of the equation will always be equal to, no matter how many transactions are entered into it. The actual asset, that's capital and liability, it will always hold true. The accounting equation is the simplest way to determine the financial position of an enterprise. Yes, if you don't understand how to run the account, and you need to understand that this capital and asset, they always come up on your balance sheet. They don't come up on your trading profit and loss account. They only come up on your balance sheet, where you balance the account to know what your account is reading for that very previous year. So you must know how to do that. Now let's move on to the business cycle. The business cycle. What we mean by business cycle. Now, let's do a business definition of business. A business is an organization established deliberately by an entrepreneur or entrepreneurs for the purpose of satisfying customers' wants and consequently making a profit therefrom. It is upon this fact that all business depend on profit from the. Now, you need to know as a business student that your first take in business is not really profit making. It's not profit making. It is later you make profit. One of the intake in it, like I used to tell my business class, is that the profit is just the first thing you do is to satisfy customers. You satisfy your customers. When you satisfy your customer, before you know it, they begin to talk to each other. Oh, have you seen so thing? Have you tasted so thing? And as you do so, you now discover that people begin to come and buy. And as they are buying, your margin goes up. Your margin is your profit. They are moving up. They are moving up until you get to state that your margin becomes so great and people begin to patronize it. And don't also forget that as the profit is going up in the business, you must do some researches, research out to be done so that you can always stay on business. Or if not, once there is a decline in the business is gone already. So it is upon this fact that all business depend on profit from the. Now, needs to understand, number one, you need to understand that your business, number one, is to satisfy customers, then customers want or need, then from there, you now begin to make profit in it. Some of us, we are just going to business just to make profit, and before you know it, the business runs down, and you are not able to make the next necessary profit that you're supposed to make. Then why business exists? We are looking at why business exists. Now, business exists to provide goods and services, and in process, earn income for the owner, and increase capital is usually referred to as profit. Increase capital. Once your business begins to grow, number one, don't forget, even in this place, we are telling you that business exists to provide goods and services. What are goods and services? Is to meet the people's needs, to satisfy your customers. And when you satisfy your customers, and in the process earn income for the owners, then your income, when it's added to your initial capital, now what you add to it gives you your total net capital, and what you gain is called your profit. You make profit after you satisfy your customers. Then we look at the business cycle, might be described as follow. A trader begins a trading period with certain assets and liabilities. The excess of assets over the liabilities being the capital. Some of these assets are exchanged for others of great value. For instance, a business owner sells a product at a higher price than the price he bought them and thus make a profit. The increase the capital, this increase the capital, he buys other assets to keep and use. However, as time goes on, the value of the asset reduces because now the value of the asset. Now, I don't want us to mix these things. There's capital on its own. There's capital. The capital produces the asset, and the asset, as the asset, some of the asset like the building, the motor vehicle, the furniture and fixing. A time comes in the life of those products that they begin to dilapidate or to begin to wear out. Now we are looking at, say, however, as time goes on, the value of the asset reduces because now we are now looking at issue of depreciation. We're looking at depreciation here. The value begin to depreciate. Why? Number one, because they wear out or are used up. They wear out. When you buy a car, the day you buy the car, you begin to put money aside for, because in 5 years, if possible, if it's not well taken care, the car goes off. But the wear and tear of it, when it's no more working as expected, you need to dispose it. Now, number two, they expire. For example, leases expires. This loss reduces capital. Again, he incurs certain expenses, which as a result in the reduction of his capital. If the increase in capital is greater than the loss, then he has made profit. Now, increase in capital is greater than the loss, then he has made profit. That means you subtract the increase from you subtract the normal capital from the increase, I mean the capital, you add the increase to the capital, then makes your capital to be greater. Then obviously the only way to find out whether or not a profit has been made is to keep a track, of value of assets and liability. And that is why a business owner keeps accounting record. You keep tracks, you are able to notify, to check. There must be a check and balance. Then now one thing people do when they buy a product, an asset, is they always keep a certain percentage for those assets. They put a certain, like the fixtures and fittings, you put a certain percentage beside in case from your profit. You set it aside for all those things because of wear and tear. If you don't set it aside, there is probability when those things get down and they are spoiled, you might not really be able to do it. So as an accountant, you put some money aside, for some of your machineries, for your fixtures and for vehicles. Those money goes into account. And at the end of the day, when they are no more useful, you sell them as scrap, add some money and buy a new model ones. Then say now we look at an unsuccessful business might find that his liability exceeds his asset. Once your liability is over your asset, there's probability you are going bankrupt or you are going to liquidate some of your assets. That means you're selling some of these assets to now make up with, and it might be dangerous because you might sell one of your most expensive assets and you might not regain them again for a long time. Then he would have no capital. And difference between asset and liability would then be called a deficiency. A deficiency. That means your liability is more than your capital. Then what you get there is called deficiency or loss. We call it loss. So now look at the equation here. The bookkeeping equation would need to be rewritten as liability is equals to your assets plus your deficiency. That is, or D is equals to L minus asset. That means your liability minus your asset, where L is your liability, A is your asset, D is equals to the efficiency. Now, as a businessman, now we talked about the going concern. If you don't forget, in our concept, we talk about the going concept. That means the business continue to grow. And you know that business is not just a now business, it's a futuristic business, it's growing and it's growing. It's a pity that in Nigeria, we have business that is not have not grown up to 25 years, 30 years. Why? Because the owner of the business even steal his money, steal his own capital. Take for example, if he's going to run a business and when they bring him a budget of 1.5 million, he say round it up, and they round it up to 2 million. Then he steal his own money. Before you know it, the business goes dead and nothing, no explanation for that. So a person or business whose liability exceeds the asset is said to be what? Insolvent. It's solvent. It's solvent. It's solvent. That means the man has no authority again. He has no more money, no more liquid to. So the business is liquidated. You can liquidate the business or bankruptcy. Now, one of your assignments today is let's write this. One of the assignments now before we continue is number one, differentiate between insolvent, liquidation, and bankruptcy. Distinguish between insolvent, liquidation, and bankruptcy. I want to see that the differentiate between insolvent, liquidation, and bankruptcy. I want you to send it send that to my email. All of you know my email, jogba2004@gmail.com. jogba2804@gmail.com. So differentiate between insolvent, liquidation, and bankruptcy. I want to send it to me. Then I want you to also write this. What is the essential difference between the debit and credit note? What is the essential difference between the debit and credit note? We did that last week. The difference between debit note and credit note, and send it to my mail as we continue. Don't forget, differentiate between insolvent, liquidation and bankruptcy. Liquidation and bankruptcy. Last week, we look at this, some other commercial terms. We look at this last week, but there are some of them we didn't check. We checked the debtor, the common term debtor. This refers to a person or an organization who owns money. For example, if Dupe sell goods on credit to Adamu, Adamu is a debtor. Adamu is a debtor. So he's owing Dupe, and Dupe account will be credited. Then we look at creditor. This refers to a person or organization to which money is owed. In example given above, Dupe is a creditor to Adamu. Adamu is a debtor to Dupe. Dupe is a creditor to Adamu. Then we look at the transaction. This refers to any dealing between two or more persons involving an exchange of goods or services for a consideration. Usually, money is a transaction. Thus, a sales of goods, a receipt of cash, and payment of wages are all transaction. Transaction is an exchange, of money for goods. Exchange of money for goods, for one goods or services. That is transaction. Don't forget, transaction is an exchange of money for goods or services. For goods or services. That's a transaction. That's a transaction. So you need to understand what transaction is. Now, we also look at invoice. We did this last week. In the document narrates that the details of goods are sold on credit and inform the buyer of the cost of the goods, trade discount, and net amount owing. The trade discount and net amount owing. Then we look at monetary value or money worth. Monetary value or money worth. This refers to the value of anything expressed in terms of money. That is its monetary value. The monetary value of a car may be 650,000 naira. Accounts are kept in monetary value. Now, you need to understand when we're talking about the cost concept that money, whatever we have in the organization, is being referred to as, money value must have a cost on it. Then we look at goods. These are the things which are bought for the purpose of reselling at a profit. Goods are those things. We have the tangible goods, we have the intangible goods. There are things we sell. The tangible goods are things we see, we can handle. The intangible things are things we cannot feel, like services. They are exchanged for goods, then selling at a profit. A trader trades in goods. For instance, clothes is the goods of a clothes merchant, while books are goods of a bookseller. Goods are also called merchandise. Goods are also called merchandise. Then trade. We have the trader. This refers to a person or an organization that buys and sells goods with the intention of making a profit. So if you're a trader, what you are doing, you buy goods to satisfy the needs of the people. Then from there, you now begin to make profit. Now, last week also, we look at source document. We look at the source document, and we talked about some of these source documents. He said, what is the source document? All account entries must be supported by some documents. For instance, the duplicate copy of this invoice used to the buyer must support record of credit sales. Any document on which an accounting entry is based is called a source document. A source document is any account that, any document that involves money, sales, and all that. They call them the source document. So, and source document, these documents may include invoice, credit note. Last week we did this. We talked about this. All these ones we talked about them: debit note, petty cash voucher, statement of account, and receipt. Now let's look at the accounting cycle. This is the process by which the capital invested in a business circulates throughout the enterprise in a manner that adds net positive, that's profit, or negative or loss value to the account. Now you see, the account starts with the capital, move on to your asset, get to your liability, move back to your capital. That's accounting cycle. Cycling from your capital to your asset to your liability is moving on. If you have other accounts like that, also like debtors and others, it circulates. But mainly it goes from your capital to your assets, your liabilities, then circulates like that. It goes like that. Then it shows the value of the organization. It shows if you have made profit or you have not made profit. Then we look at account. This is a procedure by which control is exercised in the enterprise through the adroit use of financial statistics or data that have been drawn from accurate bookkeeping of the same enterprise. Usually, bookkeeping and account always go together since both are complementary. When you talk about bookkeeping, you talk about the day-to-day entering of the books, books of accounts. Why, when we talk about the accounts, we talk about maybe monthly final accounts or the end of the year final account. Then we look at bookkeeping. This is the art of accurate recording, keeping of data relating to financial transaction in any organization. Say accurate record keeping of data relating to financial transaction in any organization. I told you that bookkeeping, the difference between it most with account is that bookkeeping is on daily basis. You do it on daily basis, every day you do it. The entries, your sales and others are done every day. Then maybe at the end of the week or the month, then the account takes it over and begin to make the financial statement. Then we also have capital expenditure. These are expenditure on goods or assets whose benefits spread over years. They spread over years and not on the current account period only. Such expenditure is usually written off over a period in form of depreciation. Like we talk about the asset, that asset when it grows to a certain stage, most especially your fixed asset, you write them off. They depreciate. They depreciate in color, depreciate, dilapidate. If it's a building, it's dilapidating. If it's other things, they depreciate, like your car, it depreciate because of wear and tear of it. Then we look at cross-check. This check can only be cashed by deposit it in a bank. Now, it usually have two transverse lines across its face. Crossing can be general or special with the latter stating the payee bank's branch or account number. A special cross-check is therefore much safer. Now, if the cross-check, maybe you would have seen it has two very line on it, but you can open a cross-check by signing in the inside. Then you now put at the back, you write something at the back, please pay pay Mr. So. That means you've opened the cross-check so that you can take the money that, or if not, he cannot take that money that day. He has to pay it into his current account, not on his savings account. Somebody who is running, who want to collect it, must be able to pay it into his current account, not savings account. Now, we look at marked check. This type of check is guaranteed by the bank on which it's drawn. It is not usually dishonored. It's not always usually dishonored. Now, it's a marked check. Now, sometimes marked check or money are being used by some of the detectives to really show that, yes, maybe something is wrong somewhere. Then we also look at wear and tear of an asset. This is due to the normal use of an asset. It's otherwise referred to as depreciation, the depreciation of the account. Then don't forget my assignment, differentiate between insolvent, liquidation, and also bankruptcy. Then also I said, what is the essential difference between the debit and credit note? We've treated some of them today, so you must know it. Now let's look at debtors, the double entry bookkeeping. Double entry bookkeeping. Double entry bookkeeping is the central core of modern accountancy. All business events are regarded as having a dual aspect. That means you have your debit side and your credit side. Since this is a foundation and the oldest known indisputable principle of accounting, it is imperative that you have an in-depth knowledge of this concept. According to Okoli, 1973, page 7, double entry principle states that for every debit entry, there must be a corresponding credit entry, which in everyday English means that for every receiver, there must be a giver. The receiver is always regarded as a debtor, while the giver is regarded as a creditor under the principle. As far as double entry principle is concerned, there must always be two parties to a transaction. Therefore, when a transaction is to be recorded, they must appear both at the debit side and the credit side. One entry at the debit side for the debtor and the receiver, and other entry at the credit side for the creditor or the giver. Put in another way, the golden principle of bookkeeping states that every transaction has at least two parties, and these parties can be either person or account, can be person or account. So we also say to you, in double entry, one of the parties is a giver and the other a receiver. The giver is referred to as a creditor, and while the receiver is a debtor. Therefore, the double entry principle says for every debit, there must be a corresponding credit entry, thus the receiver account credit. Then in summary, we see it here that in summary of double entry principle, your debit side is receiver, that is receiving account. You receive the account, you receive debtor. Then if you give, you're a creditor. What you give out makes you a creditor, that means you're giving out. Then double entry principles. These principles are A, the keeping of books of accounts, the division of each book into separate accounts. That means the keeping of books of account. That means there are books of account and names like your sales day book, your purchase day journal. All these are your bookkeeping, and they are adding to what you are doing. We call them the books of original entry of the book of subsidiaries, original entry or book of subsidiary, where day-to-day entries are being made, day-to-day sales are being made. B, the division of each book is into separate accounts. You divide the books into separate accounts. And if you divide it into a separate account, then each account is divided into two halves. Left hand side, your left hand side, that's your debit, and the right hand side, that's your credit side. All transactions must be recorded into two accounts. One account is debited and another account is credited. Then the giver account is credited with the value of whatever it's received, and receive account is debited and with amount received. Then we also look at the cash and credit transaction. Cash and credit transaction. Financial transaction may be classified into cash and credit transaction. These are briefly explained. Cash transaction, the buyer pays immediately for goods bought. Here, no account will be opened in respect of a supplier account. Step in recording cash transaction as follows. 1, prepare two accounts. Identify the giving account and the receiving account. Now, apply the double entry principle. Credit CR your giver, DR your receiver. Now, don't forget, your debit side tells you that you are a receiver. Your credit side tells you, your credit side tells you a giver. Your debit side tells you the receiver. All transactions must pass through the cash book. All transactions must pass through the cash book. Then, because of our time, don't forget my homework. I said what differentiates or distinguish between insolvent, liquidation, and bankruptcy. Then I said to us that the second one is, what is the essential difference between the debit and the credit note? Then send it to my email, jogba2804@gmail.com. That is my email for you. So by next week, we are going to start from credit transaction. Credit transaction from next week, that's from page 30. We look at credit transaction. Submit it to me before the next class. Some of you are submitting it to me even when you are not obeying the right order. If you submit before the next class, it's okay. After the next class, I will not do it. Thank you, and God bless you. Hello? But stop, eh?